Okay, Tim, I want to thank you for being on this call before. You've been on another call before when we talked about doing 504s in general. And I wanted to chat a few minutes today about doing the refinance, the SBA 504, the 7A to 504 refinance. So I appreciate you being on the call. Tell me a little bit about
Yeah, of
yourself
course.
and the CDC that you represent. How long you been with them?
Sure, Harold. Thanks for having me again. Always a pleasure discussing potential deals with you. But I've been in the CDC industry or government guaranteed lending industry this is my 24th year, specifically in 504 finance since 2004, so about 20 years there. Capital Partners Certified Development Corporation is based in Atlanta, and we cover all of Georgia. Plus a couple of counties in neighboring Alabama over near the Columbus market.
Okay. Has there, since right now the rates have gone up and a lot of these SBA loans are fully priced.
Right.
So you've got loans that are 10 and 3/4, 11 and a quarter right now, and that's got to be killing some of these people. I mean, is it really busy for you guys right now doing these 7A to 504 refinances?
Yeah, for sure. I mean, we're probably seeing about half of our volume right now in the refinance market, specifically, refinancing borrowers out of 7A loans. Like you said, they are, typically variable rate loans, prime plus. We usually see somewhere between prime plus 1 and all the way up to the fully priced ones at prime plus 275. So as you can imagine, borrowers that have seen their payments drastically increase as prime has gone up over the past couple of years are, paying upwards of 11 and a quarter, and we are able to fix them into the 504 product. Right now we are in the low sevens. So our rate has gone up as well. Obviously we were down in we got down into the twos back in 2021, but we are still a below market rate product. So our 25-year fix right now is in the low sevens, and I'm kind of encouraged recent weeks. The 10-year Treasury, which is what our rate is tied to, has started to go down a little bit. It's been on an upward trend over the past few months, but I'm seeing some decreasing in that as well. So hopefully our rates can drop back down into the sixes in the coming months.
Do you keep your on the CDC website? And what's the URL for your website?
Sure. So our website is cpcdc.com, and that's Capital Partners CDC. .com. Yeah, the rates for the 504 debentures, which is a fancy word for a bond, those come out once a month. The next pricing is actually this Thursday. So we are recording this on November 7th, and that pricing is November 9th. So once a month, we send out a rate blast to our contacts and then update our website with the current bond rate.
Gotcha. Okay. What type of requirements are there? Are any of them unusual in order to do a 7A to a 504?
Well, the main requirement that we're going to ask for right off the bat is we need to know how the 7A was used. So we are, obviously, as SBA 504, we are strictly for fixed asset financing. So SBA allows some leeway refinancing from 7A to 504. When the program first came out about 2 years ago, they required at least 85% of the 7A loan to have been used for fixed assets. So we basically go in and look at the closing statement and the SBA authorization on the 7A loan and double check to make sure we can meet that barometer. But good news, starting, I believe it's Monday on the 13th of November, SBA has relaxed that requirement from 85 down to 75%. So
that's a big deal.
Yeah, we're excited for that. Any new requests right now, we would be, going ahead and applying that 75% minimum. So if you got a, $2 million 7A loan, then we just need to make sure at least $1.5 million was used for real estate. So you can see where there still could be some goodwill or working capital or inventory included in the 7A. and just to be clear, we can still refinance the entire 7A. We don't have to refinance just the fixed asset portion. We just have to make sure at least 75% of it was used for the fixed assets. Other than that, I mean, we need to, this is not for, businesses that are less than 2 years old. So we need to see that the business has been operating for at least 2 years that we're refinancing. And then the debt, the actual 7A debt or conventional debt, whatever it might be, needs to be at least 6 months old. So those are the main kind of parameters. Once we figure that out, the loan to value can go all the way to 90%. And in that scenario, if you're at the full 90%, you're at a bank first mortgage at 50% of the value. And then our SBA second mortgage, the 504, is 40% of the value. So that's, it's encouraging that you can go all the way to 90%. And there are some cash out options. Up to currently the rule is 20% of the value can be used for cash out. So
that's good. I didn't know that. I did not know that.
Yeah, a lot of people find that strange because, historically 504 cannot be used for any type of working capital or cash out. But
right.
SBA does allow a certain percentage of the value, as long as we're staying within. And they actually, right now, they dropped the loan to value on a cash out to 85. So instead of 90, you cap out at 85 on a cash out, along with the overall limit of 20%. So it gets a little confusing. The key is to make sure you're working with a CDC that knows the program. We've probably done upwards of 50 of these refinances over the years. So we like to think we know the program, but there are good CDCs in each state. There are multiple good CDCs here in Georgia as well. So just make sure your CDC will guide you through the eligibility process. And once it's deemed eligible and everybody's agreed on the terms, the process goes through approvals, and then we get it closed so you can start enjoying that fixed rate.
Let me ask you a question. Since I specialize gas stations, car washes, things like that, I don't think I've ever done a 504 where we did 90% financing. That doesn't mean it. Aren't they a little more problematic because of the goodwill that's going to be associated with it, or?
Well, the 90%. So there's two different things there. If you're doing a gas station loan where it's a purchase or new construction, you can't get to 90% because that's not a refinance. So
right.
They cap you out at 80. They cap you out at 85 on a special use building for a gas station is special use. Refinance doesn't have that same determination. We can go up to 90% on any type of property with the refinance program, but no, that's how you can get to 90%. It just has to be a refinance. But
gotcha.
You're correct on a purchase or construction deal. You're generally in the capped out at 85%.
This is a kind of a what color's my brown dog question, but why would you want to refinance the 7A with the 504 if other than a rate? Well,
I mean, that's the main reason. Obviously, right now is refinancing due to rate. I mean, we're going to obviously lower the payment with that. Just fixing your occupancy expense. 7A, even if the rate wasn't that great of an improvement, you're fixing your occupancy expense long term instead of being susceptible to market fluctuations, up or down. That way you can, focus on, growing your business instead of constantly worrying about refinancing, every 3 or 4 years on a conventional deal or, fluctuating rates. But, that's the main reason. We do have to show at least a 10% savings on your monthly payment.
Yeah, that'd be easy. So,
which is, we haven't had an issue doing that yet. The spread is still, obviously if you have a 7A that's, prime plus 0 or prime plus, a half, it might not be as advantageous, but we all know that most 7As aren't priced like that.
Right. Nope.
They're priced closer to the maximum.
Yep. Let's see. We've already talked about, is there anything that would make you ineligible? Like, let's say that it was an industrial building and had, let's say it was a $3 million loan, but it was all equipment. Would that make it ineligible because they might have been given, say, a 10-year amortization because of the fact there wasn't real estate involved, but only equipment?
So we can still, we are fixed asset lenders. So a lot of people think it's strictly real estate, but we are able to refinance equipment debts as well. In a lot of cases, especially a 7A loan is going to be partly used for equipment, which is an eligible use. But with 504, we have three options. We have a 10-year product, a 20-year product, and a 25-year product. The 25-year is obviously the one everyone chooses for the real estate deals. The 10-year product is primarily for equipment. So if we needed to, we can put that refinance on a 10-year debenture instead of a longer term. It's all based on the useful life of the asset. So when you come to us, if that piece of equipment, there are some piece of equipment, when properly maintained, that last a long time.
Sure.
So as long as we can get a useful life statement that supports a 20-year repayment, then we're happy to do a 20-year. But in general, most equipment loans are the 10-year bonds.
Let's say it's a gas station, and on the gas station, the 7A is normally 25 years, but it's 10 years for the equipment, and then they don't. I think the goodwill is 7 or something like that, but the blended term ends up being, say, 22 years or so. Do you have to have your terms match the 7A terms? Does that make sense, that question?
Yeah, that makes sense. No, so we don't have the ability to blend a term. So we only have, since these are bonds that are sold on the market, we don't have the ability to, structure a 22-year bond or a 17-year bond or anything like that. So we're going to fit it into the one that most closely matches the remaining useful life. That might be a 20-year bond.
Gotcha.
We'll obviously push for a 25-year. The key there is, though, back to the 10% payment savings. If you're on a 25-year repayment savings with a 7A, 25-year payment term, then you just remember we have to show that 10% savings. But if you were on a 17-year or 22-year amortization, it should be easier for us to show that 10% savings because we're extending out to 25 years in most cases.
Gotcha. What are the associated fees with doing this refinance? And I also wanted to ask you, kind of parenthetically, is do you have the ability to figure out what your break-even point is? So let's say you're doing a loan and the fees are going to be $30,000 to refinance. Do you have the ability to figure out how long it would take you to break even from the savings?
Yeah, so as far as figuring that out, it's easy, obviously, since we're doing fixed rate financing, the payments are going to be fixed. So basically we can add up the costs of doing this refinance divided by that monthly payment savings and tell you that it's going to take you 12 months or 24 months to recoup that savings. But in general, much like if you were refinancing your home, it's somewhere in the 3 to 4% cost with, obviously you have to get a new appraisal, environmental reports, then, and it also depends on which bank we're using for the first mortgage. Are they charging a 0.5 point fee? Are they charging a 1% fee? Are they factoring in the SBA 0.5 point that has to be paid to SBA? So there's a lot of variables there.
What is the percent? Because they've changed it. It used to be 2% for the guarantee fee, wasn't it? And then they upped it?
Well, on the actual 504 loan, there is no guarantee fee, but there are debenture fees. So remember, these are bonds. So there are people in Washington and in New York that are, preparing these bonds for sale, underwriting these bonds, getting them sold on the market. So there are debenture fees there. And then us as the CDC, one of those revenue streams for a CDC, since we're not earning interest, is the upfront fee, which most CDCs charge the standard 1.5% of the net debenture. So remember, we're doing no more than 40% of the budget. So that 1.5% fee is on that 40% portion. But all the SBA costs, any of the bond costs, the CDC fee, even our closing costs. So all of our closing costs, for closing attorney, anything specific to the 504 loan is all 100% financed into the SBA bond and financed over 25 years. So in most cases, there's no out-of-pocket cost to the refinance, but there's no way to avoid. Obviously, the debt will increase if you're financing those costs into your request. Now, obviously, borrowers have the ability to pay the closing costs out of pocket if they don't want their debt to increase. But in general, I think on average it's somewhere between 3 and 4%, really depending on the bank fee is a variable in that. Everything else is fairly standard.
Gotcha.
But you're not having to do new surveys. And the good news is on a 7A, they've already been through an SBA closing process, so they're going to have a survey that's acceptable already. They're going to have a lot of there's not going to be a lot of things that we have to recreate. But you do have to get a new appraisal, new environmental report, things like that. But yeah, I think in general, 12 to 24 months to recoup the cost of the refinance.
I'm going to ask you to just kind of give an average here, because a 504 is more than one approval, since you're getting the bank approval and the CDC approval. How long would you say, and I'm not going to hold you to it because every deal is different, but logically, you would think that it's going to take longer on average than a 7A. If you were to ballpark it, what would you say the average length of time it is to get a 504 approved?
So for our most organized borrowers that are very responsive and send stuff in as soon as you request it, you can get these done in 45 to 60 days. Mm-hmm. For those that may have a lot of extra entities to analyze or any other variables like that, I'd say start to finish 90 days.
Gotcha.
But it's so dependent on the borrower and honestly which CDC you use. We like to think we are very efficient at getting it through our process, but you may end up with a CDC that is a little less efficient. So,
I have.
Depends on that scenario, and then the bank as well. But refinances generally move quicker because you're not waiting on a GC to give you a construction contract.
Right.
You're not waiting on the bank to review plans and specs. It's just, here's the amount you need to refinance. Let's get an appraisal ordered. Is everybody good with the terms? And then you move forward. So.
Gotcha. One last question, and I kind of asked it before. Is there anything specifically with petroleum deals? And I know they're a special purpose facility or whatever, but are they inherently any slower to get done or any more problematic than any other type?
I would say the ones we have any, obviously you're talking about environmental issues most likely.
Sure.
The delay there is usually on a purchase of an existing gas station where the seller may, not have, done their tank tightness test annually, right, or, just different things like that. But on a refinance, again, you most likely within the last few years done your 7A loan.
Sure. And
you've been through this process already. So obviously to close the 7A loan, you had a clean phase one, or if you had to go to phase two, you had a clean phase two. So as long as there haven't been any, spills or issues since then, there shouldn't be any delays. You still have to get those reports, but there shouldn't be any changes to their, no adverse or no additional investigation required, determinations. So,
something
again,
just occurred to me. Is the debt service coverage on a 504, is it higher or the same? Because it used to be, they were on, at least on a gas station, you were always looking for at least 1.2, 1.25 to 1, but on the actual requirement, I think you only had to have 1.1 to 1. How do they look at that on a 504?
Yeah, so I think the 7A requirement, and don't quote me on this because I'm not a 7A lender, but I think in their rules they have to have at least a 1.15 coverage.
Right.
We don't have a defined coverage in our program. Obviously, we want to see that they have the ability.
Of course.
Obviously, if you're refinancing something, you want to have the ability. But if you've been paying your 7A loan and now we're going to drop your payment, you would think that would make sense. But yeah, we need to be at least 1-to-1, and we're looking at obviously global, including distributions and personal cash flow analysis on the guarantors. But yeah, I mean, if you're making your payments okay on the 7A and now you're going to drop your payment, we're assuming that debt coverage works out.
Got ya. Okay. I appreciate being able to ask you these questions. Is there anything else you'd like to volunteer about you or the CDC or the process that we might not have covered?
I mean, in any 504 scenario, just make sure you know the background of who you're working with to get the 504 loan done. Make sure, there are various trade associations, and I can connect you. Our trade association is called NADCO, NADCO.org. And there are, reports on that website that you can research and make sure that the CDC you are working with, because we only cover Georgia. So obviously, there are going to be projects or people listening to this that, may need something done in Michigan or some other state. So you can get on that website and you can see who's doing the most 504 volume and choose, generally choose from those higher volume CDCs, not necessarily because I'm promoting them, but because anyone doing a high volume of 504 has consistent contact with SBA's processing center and knows, just kind of the feel of the program. They know what SBA will approve or won't approve. If you work with someone that does 1 or 2 loans a year, they're just not going to have that that same. There's going to be exceptions, but just not that same experience and knowing what's going on with the processing center.
Gotcha. Okay. All right. Well, I appreciate you making yourself available. I'll include your contact info on the video, and we look forward to doing more business with you, and hopefully this will drive some business your way too.
Sounds good. Thanks for having me.
All right. Thank you, Tim. Appreciate it.
All right.
All right.
Bye-bye. Take care.